Look at this carefully. There is a market right now where people are trading on who will win elections, what inflation will be next month, whether the Federal Reserve will cut rates, and even whether certain laws will pass. Billions of dollars are flowing through it, and most investors are not paying attention. That market is called prediction markets, and they are going mainstream. Today we're going to talk about what prediction markets actually are, why they are growing fast, the difference between regulated platforms like Kalshi and crypto platforms like Polymarket, the legal battles behind them, and why this matters for investors. Because something important is happening at the intersection of regulation, finance, and information. And if you invest in stocks, crypto, or anything else, this matters. What are prediction markets? Let's start very simple. Imagine this. Let's say your school is voting for class president. You think Sarah will win. Your friend thinks, Michael will win. Instead of just arguing, you both put $10 down. If Sarah wins, you get $20. If Michael wins, your friend gets $20. That is a very simple prediction market. It is a market where people buy and sell contracts based on the probability of an event happening. Now scale that idea up to elections, inflation data, interest rate decisions, economic reports, or court rulings. Instead of guessing, people trade probabilities, and the price of the contract reflects the collective belief of the market. If a contract trades at 70 cents, that implies a 70% probability. It's like turning opinions into tradable assets. But let's see why this is different from gambling. Now you might say, isn't this just betting? And that's a fair question. The difference is structure and purpose. Gambling is designed purely for entertainment. Prediction markets can serve as information aggregation tools, risk hedging tools, economic forecasting mechanisms. For example, if you run a business and you are worried that interest rate may rise, you could potentially use prediction markets to hedge that risk. It becomes closer to financial derivatives than to a casino betting. That's where the legal and regulatory complexity begins. Why are they growing now? Prediction markets are not new. But what has changed? 3 things: technology, crypto infrastructure, legal shifts. Crypto made it easier to create global platforms. Smart contracts made automated settlements possible. And recent legal decisions in the US have opened the door for regulated event contracts, which bring us to the key players. Kalshi versus Polymarket. There are 2 major models. On one side, we have Kalshi. Kalshi is a US-based commodity futures trading commission regulator exchange offering event contracts. It operates within the US regulatory law. Users trade in US dollars. It went through legal battles to offer political event contracts. On the other side, we have Polymarket. Polymarket operates using crypto, primarily US dollars. It serves global users. It is not regulated in the US the same way Kalshi is. So the core difference is regulatory status. Kalshi is building inside the system. Polymarket is operating outside the traditional US regulatory framework. Think of it like this. Kalshi is building a bank. Polymarket is building a decentralized financial platform. Both offer prediction markets, but the legal environment around them is very different. Let's simplify it even more. Imagine 2 lemonade stands. One gets a permit from the city. They follow all the rules. They pay taxes. That's Kalshi. The other sets up outside the city limits. They don't need city approval. That's closer to Polymarket. Both sell lemonade. But one operates inside regulation, one operates outside traditional regulation. That difference matters for investors. But the real turning point wasn't the platform structure, it was the legal battle. Let's see the legal shift. In 2020, Kalshi was officially approved by the Commodity Futures Trading Commission as a regulated exchange. That means it became legally allowed to offer event contracts in the United States. This was the first step toward legitimacy. In 2022, the Commodity Futures Trading Commission charged Polymarket for operating an unregistered derivatives platform accessible to U.S. users. Polymarket settled the case and paid a civil penalty. This confirms something important. Prediction markets fall under the U.S. derivatives law when offered to Americans. In 2023, the Commodity Futures Trading Commissions blocked Kalshi from offering congressional election contracts. The regulator argued that these contracts involve political activity and could be against the public interest. This was a major restriction. It signaled that election markets might not be allowed, even on regulated platforms. Then, in 2024, a federal court ruled in favor of Kalshi. The court allowed the listing of certain election contracts. This was a turning point. It limited the Commodity Futures Trading Commission's ability to block political events contracts, and it reopened the door to regulated election markets. Let's explain this in a very simple way. Imagine you want to open a school club where students trade predictions. First, the principal says yes. Then the school board says no. Then a judge says yes again. That is essentially what happened here. The regulator said no, the court said yes, and that changed the direction of the entire market. This timeline shows the shift from restriction to expansion, and when regulation shifts toward expansion, capital usually follows. This is not just about betting on elections, it's about whether uncertainty itself can become a regulated financial product. Recently, U.S. courts allowed regulated platforms to offer election contracts. That was a major moment because it blurred the line between political forecasting, financial derivatives, and betting law. This isn't just a tech story, it's a regulatory evolution story. Again, and whenever regulation shifts, capital flows. This timeline shows the shift from restriction to expansion. But why investors are not ready? Here's the uncomfortable truth. Most retail investors don't understand derivatives, don't follow the U.S. Commodity Futures Trading Commission's ruling, don't monitor event contracts approval. So when this market scales, they will encounter it after institutions do. That is usually how financial innovation works. First, infrastructure, then institutions, then retail awareness. We are somewhere between stage 1 and 2. Important disclaimer, before we go further, this is not financial advice, this is educational analysis. Prediction markets carry legal risk, liquidity risk, and volatility risk. Always do your own research and understand your jurisdiction. Now, let's continue. Let's see the money implications and why does this matter financially? Because prediction markets could become a new asset class, a hedging tool, political risk pricing mechanism, and a macroeconomic forecasting tool. So imagine this scenario. If prediction markets show a 90% chance of a major tax change, markets may adjust before the law passes. Information becomes tradable, and tradable information moves capital. That changes how investors interpret signals. Now, let's stay grounded. Risks include manipulation, low liquidity, regulatory reversals, Platform risk, political pressure. If governments decide these markets distort democracy, regulation could tighten. If liquidity dries up, prices become unreliable. So this is not risk-free innovation. It is financial experimentation in real time. Let's see the future outlook. Here is a key question. Could prediction markets become as common as stock exchanges? Possibly, but only if regulation stabilizes, institutional participation increases, public trust grows. If that happens, we may see banks offering event contracts, hedge funds hedging political risk, corporation pricing regulatory outcomes. This is still early, but it is no longer fringe. It is moving towards mainstream. Remember that prediction markets represent something deeper. They represent the financialization of uncertainty. Instead of debating outcomes, we price them. Instead of arguing, we trade probabilities. That changes how society processes information. And most investors are not thinking about that yet, but they will. Thank you for watching until the end. And if you found this episode valuable, please like and subscribe. These videos require research and preparation, and your support truly helps this channel grow and continue delivering thoughtful financial analysis. Until next time.